Drew Brantley here with Inside the Exit. Welcome back to another edition. Today, we're going to be talking about part 4 of preparing your company to sell. So if you've watched the other 3 parts, if you haven't, I would highly recommend you do that. And by the way, while we're on the topic, go ahead and hit subscribe and be sure to check out our many other videos and stay tuned to our other ones that we come out with in the future. So be sure to hit subscribe. But part 4 of all 4 of these preparing your companies to sell, this one might be the most important, Bob.
Without a shadow of a doubt.
So financials, that's what we're talking about today. It's all about financials because when somebody buys your company, your numbers that your company is producing is one of the first things they're going to look at. And you know, those numbers, they're going to look for those numbers to tell a story. And that story very simply is going to be how do you make money and how do you spend money? And then the details, all the devil's in the detail of how you're making money and then also how you're spending your money. That's what people are really going to look at. So in this video, what we want to do is we want to break down a couple big kind of trends and things to pay attention to. And then also we're going to talk about some specific items within your financials that people are definitely going to want to look at. Now, your business is going to be unique compared to other people's, so most of these categories are going to apply to everybody that's watching this video. But your unique business might have a few nuances, so feel free to reach out if you do have some questions about your business specifically as it might apply to you.
Yeah, absolutely. The financials and what we're going to talk about right now is critical. Obviously, it is the company, in so many words, as you said, a story. And so it tells a story. Yes, you make products, or yes, you sell services. Whatever you do, we understand that. But then they're the numbers that reflect what you do. And those numbers over a period of years and things, and we're going to talk about a number of different details behind those numbers, but it's critical. And so for your understanding how they work and to be able to answer questions about them, that's the whole ball game here when you're out there selling your company. It's critical.
Absolutely. So if you don't know your financials, you need to figure them out. So if you're doing all the numbers and let's say you're managing the whole thing out of a bank account, which some people do, I've been guilty of doing that in businesses in the past, then you need to find somebody to help you get a handle on your numbers, whether it's a friend, an accountant, a bookkeeper, a neighbor next door, a family member, somebody that can help you get a hold of your financial statements so you can really get a handle on what your numbers are, not just for the moment in time when you're looking at it, but also over a multi-year period, because that's one of the things people are going to want to look at is your financials going back at least 3 years, ideally longer than that. So let's kind of start big, Bob, and let's talk about a couple trends that people should be aware of, and then let's kind of get granular as we go.
Yeah, and one final point about this. A lot of companies have a controller, have a chief financial officer, maybe a treasurer, or somebody that, or even a bookkeeper that's watching all the numbers. But you're the owner of the company. And I'm going to say this, and I understand you may not have an accounting background. You may be the most brilliant guy in your industry selling and making this product. I understand that. But the more you know about your own numbers when it comes to selling your company, the more you understand them and know what's behind them, even though you may have somebody else that's looking at them day in, day out, hour by hour, it's useful. So keep in mind that this is not something that we're saying you have to know every single detail about your numbers. Yes, if you're the only person, that's a pretty good idea to know all the details. But if you do have somebody else, that's really great. But it's a good idea to have a very good overall picture about what's going on with your numbers, with your processes inside your company.
That's a great point, Bob.
Thanks. So keep in mind, we're going to go through these details, and this is something, and we understand that a lot of you sellers out there have a whole different way. Maybe you're an expert in marketing, but the numbers are important to the sale process.
Absolutely. All right, so let's talk about a couple trends that people are going to be looking at. The first 2 things are percentages and trend lines. Okay, so when I'm talking about percentages, I'm looking at percentages when you're kind of analyzing the numbers. Things like your gross margin percentage. So how much are you making kind of after your COGS or your cost of goods sold, or your EBITDA margin, or things like that. Those percentage numbers are going to be really important. And so one of the things people look for is consistency in those numbers. Especially like around the COGS themselves. They want to know that you have a handle on those COGS, the cost of goods sold, and they're not bouncing around. So if you've got a percentage maybe that's 75% one year and then it's 42% the next year, that's a lot of variability in that. And so people like to see consistency in a lot of percentages. Now, within that, or separate from that, are trend lines. So trend lines could relate to percentages because it could be that your trend lines around your EBITDA margin. People love to see that trend line going up. That means you're making more money at the end of the day, okay? But trend lines are really important. So if you think about your revenue or your net income or your EBITDA, your earnings before interest, taxes, depreciation, and amortization, those numbers, ideally, people like to see trend lines that are moving upwards. They might vary on a monthly basis. You might, have some variability. They might be up and down a little bit from a month-to-month basis. But on an annual basis, if you're looking back kind of 3 to 5 years, are the trend lines moving in the right direction? Kind of the same thing with the COGS. The COGS, though, it could be that they're flat or they're consistent, or your expenses, your cost of goods sold or expenses are fairly flat, or are you able to create a situation where they can go down? Some people, the more business you make, the cheaper it is for you to produce something, so your COGS or your expenses are actually able to go down. So again, as you look at your numbers over a multi-year basis, the big thing for the big question you should ask yourself are, what are the trend lines? Do my numbers go up, or do my numbers go down, or do they stay fairly flat or consistent? And then when you look at the percentages, what are those percentages doing? Because those trend lines and the percentages are going to tell a story at a high level. So anybody that's buying your company, they're going to start looking at the numbers from a high level, ideally on a multi-year basis, and then they're going to get granular. They're going to look at the details of what's causing those numbers to do what they do.
Yeah, we can't stress enough how important the margins are and how a seller is going to be asked about his margins, not just the sales line. I mean, take a simple example. Your sales go up, but the cost of goods sold underneath those sales also goes up. And if it goes up too much more than it has in the past, your margin, your gross margin is going to go down. And so as a result, while sales may have gone up, your gross margin went down. That's a bad sign. Now, if it happens, it happens. And I'm not saying but you better, again, the numbers tell a story. So you better have a reason why that's happening. We took on a new client. That new client, we had to give this price up front, and it's going to get better over time. So yeah, it did hurt our margins a little bit. There are all sorts of reasons why things may or may not happen, but those percentages, as Drew said, or margins, are very important, and there isn't a buyer in the world that's not going to look at those percentages.
Yeah. Or look, maybe you invested in your company. Maybe you hired people, or you built a new building, or got some new equipment that expanded your capacity. And to Bob's point, it might pay off over time, but it's going to affect the numbers in the short term. So you've got to be able to explain why the numbers are doing what they're doing when you look at it from a trend perspective.
Absolutely.
Yeah.
No.
All right. So now let's get a little bit granular. So we're going to talk about some specific line items, on your financial statements. And for most of you, again, these are going to be things everybody's going to have. The details of kind of your business compared to somebody else is going to be a little bit different, but let's talk about a few different things. The first thing we're going to talk about is revenue. So we have a whole video about customers, pipeline, and backlog, really about how you make money. So we've already covered a good bit of this. So if you haven't watched that video, I believe it's either preparing 2 or 3. I can't remember which one it is, but check out one of the other, preparing your companies to sell. It's all about that, and it's really about how you make your money. So this is important. But again, if we go back to the revenue line specifically in the sales, one of the things that's important is that trend line, and is the trend line moving in the right direction? Now, companies are not always perfect. In an ideal world, yes, we always want to see, the hockey stick growth, and this thing is just taking off, and boom, we're growing to the wind. But the reality is, not every company does that. I mean, a lot of the companies that I've run or own today, we vary from year to year. Some years are better than others, or some companies kind of plateau out. If you're in a franchise business, for example, a lot of times in those businesses, you have a certain number of years, maybe 2 or 3 years, that it takes to ramp a store, and then it's going to plateau. And you might only see, 2% growth year over year after that. So it's okay if the numbers are flat in certain industries. So don't take it that yours has to be a hockey stick. But again, looking at what does that trend line tell you, and what does that tell you about your business? Maybe your revenue numbers are flat because you're at capacity, or maybe you're a franchise business, like I said, and you've kind of plateaued with that one location. That's okay, but again, they're going to tell a story that you're going to need to explain. So again, looking at that revenue line and really looking at the trend.
Yeah, you'd be surprised if you have the story, if you have it, or you have the reasons behind is the best way. Whatever these numbers are, it goes much, much better. A buyer that comes in to look at your company goes, "Oh, that makes a lot of sense. You're at capacity. You can't grow that much more." And then they may question you about, well, if you added another plant, another shift, whatever it may be, what would happen? And then you go further into the story, but it's so important to know what is going on and why it's going on.
Absolutely. So let's keep moving down the line. The next thing I want to talk about are COGS, or the cost of goods sold. So I mentioned this a minute ago. COGS are one of those things that you need to be able to understand what your cost of goods sold are, meaning what does it cost for you to make money? So if you're manufacturing stuff, you've got raw materials, you've got labor, you've got all, electricity, whatever it is that goes into producing your product or generating revenue. And what are those things? Depending on what you do, some of it's going to be higher, some of it's going to be lower. So there's not a percentage of your revenue that is the right or wrong percentage. With COGS, again, the real important thing around this is, do you have a handle on it? And are you able to keep them fairly consistent, or maybe you're able to reduce them over time? That's what people are going to look for around your expenses or your COGS is, are you able to keep them consistent? If you look at them on a month-to-month basis, you might see some variability, but on an annual basis, over a multi-year basis, are they going to be fairly consistent? So, maybe yours range from 45 to 49%. So, within 5 percentage points, over a multi-year basis, that's going to be okay in most people's eyes, meaning you've got it in a decent range. But if you're going from 70 to 40 to 30 to 60, that's telling them that there's some wild variability in what it's taking for you to generate revenue. So at that point, that's going to really affect your gross margin at the end of the day, which is really the next line item that we want to talk about. So that gross margin at a high level is saying, how much money are you making after expenses? Again, we're going to go back to trend lines. This is one of those trend lines where people are going to want to see, is it consistent? Is the gross margin consistent over time? Or is it able to decrease or increase? What's causing that trend line around the gross margins is really important.
Yeah. Again, it's a simple calculation, but that trend line, those percentages are incredibly important, and then it's further dropping down into other percentages and other expenses that may be hitting that aren't necessarily your cost of goods sold. But you got to pay attention to all that. You're going to be asked about that, and it's all very nice that you know your company, know your industry, know everything else about it, but it's a good idea to know what's going on behind the numbers.
Absolutely. So now let's talk about what money you're making at the end of the day, because the gross margin is just a margin. As you get further down the line, the next line a lot of people are going to look at is your net income or your EBITDA line, or EBITDA, or earnings before interest, taxes, depreciation, and amortization. People pronounce it different ways. It's all related to the same thing. Now, net income and EBITDA are not always the same thing, but for some companies, they can be fairly close. EBITDA is not a perfect measure of the value of a company or the cash flow of a company, but it's one of the best indicators that we kind of have right now. So that's what a lot of people use when they look to value a company, because it's basically saying, how is your company performing? What's kind of a general sense of the cash flow of the company before you take on things like potential debt. Some people might have, debt on the company that's helping them grow. Other people might have no debt on their company. So it's a way to kind of level out the playing field at the end of the day when it's looking at the cash flow of the business.
Yeah, it's a measurement of your cash flow at the end of the day. It's the best one we've got. It's before the taxes. Your taxes might be different than the next company across the street. So you want to take a measurement of the monies before taxes. You want to take it before an interest expense on a debt, because he may have debt and you may not, as Drew pointed out. So from the point of view of all this, and then the depreciation expense you might have might be very different than the next person's depreciation expense. So we're trying to get up to a number that really is, what is the company generating? What is from the revenue, take out the cost of goods sold, take out the other expenses that may be up against it, coming down. And it's a little bit more than the operating profit, but it's close to the operating profit. But net income takes into effect all these other things, interest expense, as well as the depreciation expense, as well as interest, the taxes. Sorry, it takes into, so the net income number is at the very bottom, and that takes in all these things that yours may be different than the next guy. But if you can go up to the EBITDA, earnings before interest, taxes, depreciation, and amortization, then all of a sudden you start to get a basis by which your company's cash flow, that's what it is. And it doesn't really vary very much from the other guy that's got his sales, his cost of goods sold going down, his selling expenses that he may have, and coming down to this real cash flow number. And so it's a really good measure, and it's a really good idea to know what your EBITDA is.
Absolutely. So, those are kind of the main numbers at the beginning that we would say look at on your financial statements, get a handle on those. Now let's go real quickly to the balance sheet, because we want to talk about a couple numbers or line items on the balance sheet that are really important. And it's very simple. Accounts payable and accounts receivable. These are the two that most people are going to begin looking at. It's going to be some of the first things that they go to look at. Accounts payable, what do you owe other people? And specifically what they're going to look at is, from a month-to-month basis or on a year-to-year basis, what do those payables look like, and how are you managing those payables? Are you paying them in a reasonable amount of time? Are they fairly consistent year over year or month over month? Or, as your business grows, do they grow? There's a lot of reasons they can do what they do, but they're going to look at, again, what are the trend lines around them? And then how are you managing those payables? So, be sure that you're prepared to talk about those payables and kind of how you're doing it. And if you do have any abnormalities, you didn't pay somebody and, for 6 months and there was some litigation around it, or they put a lien on you or something like that, you're going to need to be prepared to talk about that, because they're going to want to understand what happened. Might be a very legitimate reason why you did it or why it happened, and that's fine, but just be prepared around that. On the receivables, that's how quickly are you collecting money on whatever it is. When you invoice somebody, how quickly are you getting that money? So, it goes on the balance sheet until you get paid. And specifically what people are going to look for, or they're going to ask for, is what are the aging of those receivables? And what they're asking is, how quickly are you taking money? And usually what people are looking at is, do you collect it in 30 days or less, between 30 and 60 days, between 60 and 90, or are the receivables over 120 days old? Now, if you have receivables that are over 120 days old, then typically people are going to look at that as a negative. Now, there are some instances where, in some specific circumstances, where that might not be the case. But in general, if you're taking more than 120 days to collect on your receivables after you've billed somebody, then people are going to view that as there's an issue with how you're collecting that cash, or your customers paying. Could be good or bad. Most people are going to assume it's going to be negative. So a lot of people are going to want to see that your payables are mostly in that 30 to 60 days. 60 to 90 is not that bad, but if you start to approach that 120, that's when people are going to start to get a little bit scared in general.
Yeah, that's absolutely true. There's certain industries that it takes a long time to collect your receivables. You just need to know that. You probably already know that from your company and being involved in owning the company. But that idea that it takes a long time and that's normal for the industry, that's fine. That's what's going on in the industry. But as a general rule, people want to know that you have good systems in place, good systems to collect your money, good system to make you. All these things are very important. And the better the systems, the better it is when you go through the sale process.
Absolutely. I want to give an example that might be unique around the accounts receivable and the aging, because we were looking at a company recently, and when we were talking to the seller, we were looking at his receivables and the aging, and he had a good amount. It was over $1 million of receivables that were well over 120 days. I mean, I want to say they were close to almost a year. And when we talked to him, we said, well, what's going on with this whole bucket of receivables? Most of them were really good. They were less than 60 days, but they had this big bucket that was kind of outstanding. And as we got to talking to him, he said, well, that was a customer that was getting started, and we chose to make a business decision to kind of help them get in business. So we allowed them to push their receipt or not pay our bills for almost a year, to allow them to kind of get their feet underneath them and manage their cash flow a little bit better. And he said, we're expecting this to come in, and he was able to show exactly when, they were going to be getting paid for that. And that's a unique situation where, again, on the surface it looks bad, but when we started to ask him about it, he said, look, we helped this guy get in business. It's going to be a customer we're going to have for life. It's going to make us a lot of money over time. And we're going to bring that down over the next 12 months, and we've got a plan in place, and they're already beginning to do that. Once we heard the story, we could get comfortable with it. So I know Bob and I keep harping on this trend lines and stories and what is the story telling, and you've got to be able to explain what the story is around your numbers. So again, that's an example of where looks bad on the surface, not bad when you get into it, but you do need to be able to explain that story, whatever it might look like.
Yeah, this is really important. We've been in so many meetings with sellers selling their companies, and even buyers buying the companies. But here's the thing that I think every seller needs to understand more than you may know as a general, oh yeah, I sell here, I do this and I do that and everything else. But to take time and really study your numbers over the last 3 years, over the last 3 or 4 or 5 years, and go behind the numbers and be able to talk and really present what's going on in your company and what has gone on. It's a really great exercise if you're going to go through the sale process, because people are going to come in and ask you, and they need to hear it from you and your explanation, and it needs to be clear and concise and moving down the track to help them understand what the story is behind your numbers. The more time you spend looking at this and studying it, we actually have, when we're working with companies, we actually go through mock interviews almost of the seller. We go through as if we're buyers, pounding them. Okay, now let's see. What about this? What about that? It's not a process that we're in any way trying to do anything except prepare them, just like a football team would have practice after practice after practice, getting ready for the big game. It's the same thing.
And that's a really good point, Bob, because it's important to understand what people are listening for. Because a lot of buyers out there, especially the really sophisticated ones, they're listening for specific things. And it's something that I'd say, I'll brag on us, we've gotten pretty good at knowing what buyers and sellers are looking for. And we know the words and what they want to hear and what they don't want to hear. And so it's important to have a handle on how you should be answering this question, the different questions you get, how you should be explaining what it is that you're doing or answering a specific question, because you could say something, thinking that you're saying the right thing, but at the end of the day, it's the thing that, they go, nope, not buying that company.
Right. So what we're talking about here may be something you understand already. It's not complicated. It is relatively simple, and you probably know a lot of this. But that idea that you look at it and you practice it and you really get behind it is incredibly important for your sale process. We cannot stress enough that being able to answer the questions in a way that everybody understands, in a way that clearly tells the story, is critical to the sale process.
Absolutely. So there's one other thing that I want to talk about, if we can get back to the numbers real quick. I know we got off on a tangent, but we can't stress how important that tangent is about understanding and knowing your numbers. The last financials that we want to talk about are capital expenditures, or CapEx, as they're often referred to. So when you're looking at CapEx, you typically have two categories of CapEx for most businesses. You have maintenance CapEx, and maintenance CapEx or capital expenditures are the things that you have to do on an annual basis. So if you're a manufacturing company, let's say you have to service pieces of equipment, or let's say you have, a fleet of tractors or something, you have to do certain maintenance CapEx to keep the equipment running. You have to invest in certain things to keep your facility going. And that maintenance CapEx is done every single year. And whether you're running this or a future buyer is going to run it, they're going to have to spend that money. So that maintenance CapEx is important to get your hands around. And that could be different from your COGS or your cost of goods sold, because your cost of goods sold are really what it takes to produce whatever it is you produce, whether it's a service or a product at the end of the day. But your maintenance CapEx is really about running your facility or your equipment, or operating your business at a high level. Now, the other piece of CapEx are kind of the one-time CapEx things. So a way to think about this is, let's say you're a manufacturer and you're buying a piece of equipment, and that equipment might cost $500,000, but it's going to last you 20 years. Well, you're not going to spend $500,000 every year. You're going to spend $500,000 once every 20 years to buy that equipment. That's a one-time capital expenditure, and you're going to get a lot of life out of that. But then every year you might spend, call it $5,000 of maintenance CapEx maintaining that piece of equipment. So that's a way to differentiate between the two. So as you're looking at your capital expenditures, be sure that you differentiate or break them out into kind of one-time CapEx things, and roughly how often you're going to need to spend that kind of money for whatever it is. And then your annual kind of maintenance CapEx, to operate or maintain your equipment, your facility, your people, whatever that might be.
Yeah, it's true. There's the EBITDA that we talked about earlier in this video and other videos. That's your measure of cash flow. But if there's a capital expenditure number that's coming through each year, or there's a capital expenditure number of a large piece of equipment that you're going to need in 2 years from then, that EBITDA is going to be minus that CapEx number. So you've got to be very careful that the true cash flow of the company, you need to have the maintenance CapEx, and you need to spend capital expenditure buying that new truck, that new piece of equipment, whatever it may be, or that new facility. It doesn't matter. It's an important part that comes out of the EBITDA, and it's a measure of the cash flow. So EBITDA minus CapEx is really the true measure of your cash flow of your company.
Now, it's a good point to bring up, because as you talk about valuation, this can be a touchy subject for some sellers, and they'll say, well, my company's worth this, or it's worth that, or whatever it might be. And as a lot of buyers look at multiples of EBITDA, so maybe, it might be appropriate for a company of your size to sell for 4 to 6 times EBITDA, depending on your company and your size or your range. That might be an appropriate EBITDA. Well, if it's EBITDA minus CapEx, then all of a sudden that sale price to you, or the valuation, is going to go down. And so sellers can sometimes, they don't understand around this topic. One way to think about it is, if it's necessary for you to spend this money on a consistent basis, whether it's annual or every couple years, then whether you're buying it or whether you're owning the company and running it, or whether somebody else is going to do it, they're going to look at that as that's part of doing business. So they're not going to give you credit for that from Bob's perspective, as he was saying, on the cash flow of the business, because that's necessary. There's a little bit of a gray space here that I'm trying to highlight, and this is where I'm getting to about this. If your maintenance, let's say you're a company that's doing $5 million of EBITDA, okay, and you've got, call it $100,000 or $150,000, maybe even $200,000 of CapEx on an annual basis. That's a fairly negligible number in the scheme of things when you're looking at a company of your size. Now, if you're a company that's making $1 million of EBITDA and you have that same $100,000 or $200,000 of maintenance CapEx every year, then all of a sudden that's a more meaningful number for your business. So, as you're looking at that CapEx, sometimes if it's small enough, people aren't quite as concerned about it. But if that number really becomes begins to be material, it really can be a big deal. And I'll give you an example. Recently we were looking at a construction company, and the construction company was doing, call it roughly $6 million of EBITDA on the top line. Now, this company did site preparation, so they had a lot of heavy equipment, or yellow iron, or yellow steel as people call it. They had to buy tractors and graders and bulldozers and all sorts of stuff to do what they did. So every year they were having to buy new equipment, and they were maintaining their existing fleet. So while they were doing $6 million of EBITDA, their maintenance CapEx was about $500,000 every year just to maintain their existing fleet. But they were also spending an additional about $1.5 million every year buying new equipment. Whether it's bulldozers or tractors or trucks, that's what they were spending every year to be able to kind of keep up with what they were doing, because they were having to recycle or sell off or retire old equipment. They were having to buy new equipment every single year. So at the end of the day, when you combine that maintenance CapEx and then the one-time CapEx, which again was fairly consistent year over year, you're looking at about $2 million. So when people are looking at that company and potentially valuing that company, to Bob's point a minute ago, they're going to take the EBITDA, which was 6, and they're going to subtract that $2 million of capital expenditures, both maintenance and one time, and then they're going to get a number that's around $4 million of EBITDA, and that's probably the EBITDA number that they're going to look at when they're valuing that company.
Yeah, that's just the simple math, and it works that way. So one of the questions we often get asked when we're dealing with sellers is, do I go ahead and spend the money on a new plant or on some capital expenditure knowing that I'm about to sell my company? Will I get credit for that? Or do I just hold off on that and wait? It's not a simple black and white decision. It's something that we have conversations with our clients all the time about this. So sometimes you're going to absolutely get credit for it. It's something that makes a lot of sense. It's going to show everybody that cash flow or EBITDA is much greater, and it comes to fruition because you went ahead and spent the money. On the other hand, sometimes you decide, no, right now they may not value it the way I want them to. It may not produce what I think it's going to produce. It's kind of iffy. Let them pay the bill in that future point. And as we just pointed out, that could affect the valuation to a certain extent. But then again, are you going to get the credit? It's a question that only you can answer by looking at this very specific transaction that's going on. But it is a valuable and very viable question about spending money on the capital expenditures as you're going into a sale.
That's a great point, Bob. So I know we've talked about a lot of stuff. Bob and I have rambled on some different topics, but we felt it was important to get some of this information out. This is not everything you need to look at, but it's a good starting place if you need to know where to start looking and where to start learning about your own numbers and your own company. We're here to help. If you've got other questions, if you want to talk about your company specifically, we're more than happy to sit down with you and kind of digest what you're doing and what your numbers look like and give you some feedback and some suggestions. Whether you're preparing your company to sell or whether you just want to help increase the revenue or income of your company and want to figure out how to improve your operations, we're here to help. Reach out to us. Check out the show notes below. Please hit subscribe and check out our other videos. Thanks for watching this edition of Inside the Exit.
Thanks.